Welcome to Wine and Real Estate, the podcast where we drink wine, we have fun, and we learn about real estate investing. Real estate investing is so much more than just buying buildings. It's about building relationships, building your dreams, building your dream lifestyle, customizing your life. What do you want to do? What do you want to achieve? It's much more than money. It's more than getting rich. It's a different type of wealth. It's the wealth of time, the wealth of freedom. And now let's get to the wine and the real estate. Let's start this episode with some financing tips from our go-to mortgage broker, Streetwise Mortgages. Over to you, Dalia.
Hi, I'm Dalia, founder of Streetwise Mortgages. We all know by now that the rate environment is shifting and that interest rates will continue to rise as the Bank of Canada aims to control the higher than expected inflation. By the end of 2022, the Bank of Canada is expected to increase the overnight rate to get to a 2% target, which really translates to another 1% rate increase from the time of this recording by the end of 2022. This will have, of course, an impact on all variable rate mortgages, lines of credits, and unsecured loans. Also, more increases are expected in 2023. The pace at which this will be implemented depends on how inflation plays out and the impact on the economy. In this episode, I would like to equip you with various strategies to plan for the rate environment ahead and to help you make an informed decision. The first one is whether or not you should lock into a fixed rate. Right now, the gap between a variable and a fixed rate is about 150 to 170 points for residential mortgages, meaning if you were to choose between a variable and a fixed rate today, you will pay a high premium to lock in. In the past, this premium used to be a lot smaller. So, as we stand, variable rate has a good runway to rise to where the fixed rates are currently. Further, choosing a fixed rate right now presents a risk of locking at the peak. Rate increases are expected to ease up once the Bank of Canada gets a handle on inflation, which is projected to be anywhere from 24 to 36 months. For real estate investors in particular, variable rates offer flexibility for equity takeouts as investors rely on equity to grow their portfolios. So if you choose to stay with a variable rate, I would suggest that you stress test your portfolio. We have developed a complementary calculator to help you do so and to assess the impact of rising rates on your cash flow and on your monthly budget. There are several ways to address any impact by creating capacity in your budget. This includes the following. 1. Extending amortization on select loans, which will help you lower your monthly payment in some cases. 2. Being proactive about paying down any expensive debts that you may have with cheaper money. And 3, converting portions of some of your mortgages to an interest-only loan if needed, which again would reduce the monthly payment on the loan. You also need to be aware that as rates rise, mortgage qualification will get tighter and tighter, as qualification is tied to interest rates under the stress test rules. And where we are right now, we are approaching a point where the new rates will impact mortgage qualification, as the banks will use the higher of the rate plus 2% or the Bank of Canada qualifying rate at 5.24. So I suggest that if you have equity in properties, is to basically take the time to set up lines of credits and set up capital on your properties while the values are still holding up and while qualification still works. If you're planning on purchasing, it is best to be proactive about planning your finances and utilize any debt management or income generating strategies with your mortgage broker to keep your borrowing power at its best. And lastly, there is an expectation that values may soften in some markets, and I strongly recommend that you keep the appraisal condition in your offer to protect yourself against any value surprises. If you would like to get a copy of our rate scenarios calculator or explore options for how to hedge against the upcoming rate increases, our team at Streetwise Mortgages would be happy to assist. Email us at info@streetwisemortgages.com, and cheers to your success.
Hello, everyone. Welcome to Wine and Real Estate. So today I'm excited to be chatting with my friend Dalia. Dalia from Streetwise Mortgages and Streetwise Wealth as well. Sorry, I kind of revealed a secret there. But we're going to be having an interesting chat about scaling and different strategies to help you, like creative financing. So welcome, Dalia. You've been in the business for a few years. You know the ins and outs. So, what are your kind of top recommendations for investors in 2022?
Well, thanks, Francois. I always enjoy chatting about investing and mortgages. And right out of the oven today, Bank of Canada raised the rate
Yeah, and how is that
after,
affecting things?
after 2 years of holding off. So I'm sure some investors are anxious, thinking, oh my God, the rates are going up. What do we do? And I tell everybody, there is no reason to panic, especially investors. Here's the thing. If you're on a variable rate mortgage today, there is a spread of about 1.5% to lock into a fixed rate. So that's quite a bit of a premium. So there is a runway for variable rates to go up, number one. Number two, I am a big fan of variable rate mortgages, even though the rates are going up for investors. I'm a big fan of variable rate mortgages because you want flexibility as a real estate investor. You want to be able to recycle that equity and continue to grow. You want to be able to tap into equity once you renovate, and variable is your friend. Yes, you may be a little bit exposed, but honestly, there is quite a bit of room for rates to go up on the variable rate side. So no need to panic, no need to go and rush and lock into fixed rate mortgages. And that's really hot out of the oven today.
Yeah, no, I love it. And it's so true. I was speaking with my wife at lunchtime about this exact conversation. How is this going to affect us? Because we have a lot of variable mortgages. But as you said, it's more about the terms and not just the rate itself. And of course, if 0.5% makes or breaks the deal, it wasn't a good deal to begin with, in my opinion. So
Absolutely. You can't assess a property based on where the rates are today. You always have to factor an increase. And if your numbers are still healthy, healthy, great. That's exactly it, Francois.
that's perfect.
Yeah.
And then you sent me an email, so we're going to be very open with some great ideas about 8 building blocks. So is interest rate a building block or not?
Well, here's the thing. I think you're referring to what we call the financing roadmap, which is
Yes.
an exclusive methodology for financing investment properties to scale. There are 8 building blocks, and I'm happy to walk through them. Definitely, as part of a financing roadmap for an investor, we look at interest rates. We look at where are the opportunities to lock if needed, where are the opportunities to save, where are the opportunities to accelerate payments. So definitely the interest rate discussion, as much as the rate alone is not as important, it is part of the strategy discussion for
Yeah.
the investor, right?
That's it. If now we'd buy with credit cards at 24% and we'd be good, but we're not there yet.
Yes, exactly. So yeah, there are 8 building blocks for the financing roadmap. We'll walk through them. I'll explain how this typically helps investors, and the rate discussion is always part of that roadmap, anyways.
Yeah, and it's interesting to see like half a point, how it goes up, 1%. How does it affect your cash flow, building in that buffer? So a financing roadmap, that sounds really exciting. A lot of my students and my audience ask me all the time, what's the best way? Like, do I lock in this house? I buy this, I buy that. You do need to have a plan, because if you go on a buying rampage, you can kind of block yourself from maybe better products or better services. So, can you walk us through kind of briefly what that looks like? And
Yes. So we're big fans of planning and strategy. And as much as the language on the street is mortgage this, mortgage that, mortgage is just, a small element of money. As a real estate investor, you really want to think ahead about everything money with respect to
yeah,
growing your portfolio. And you really want to be proactive about figuring out where is the money going to come from? How are you going to maximize your borrowing power? How are we going to structure your deals in order to enable your growth? What sources of money do you use first? Like sometimes, for example, investors have joint venture partners or have private money or traditional mortgages or commercial mortgages or alternative mortgages. Which sources of money do you use first as an investor? So all of that is part of a planning conversation. And we've created an exclusive methodology that we use with investors. We call it the financing roadmap. Essentially, we sit down with every client for about an hour to plan out 8 blocks of financing. And the investor walks away at the end of the day with a kit called the financing roadmap that gives them clarity on how they're going to move forward, at least to purchase their next 3 or 4 properties. So these 8 blocks, Francois, are the following. Block number 1, we call it assessing your current state. If we want to sail a boat, right?
Yeah.
Towards the destination, we have to know where we are right now on the map. We need
That's
to know
it.
how things look right now. We need to get that pulse. So we go through the exercise of understanding where you are right now in terms of your finances. Okay, so that's number 1. Then we talk about your goals. Okay, if we're setting up financing without that discussion, then we're setting things out of context. I want to know, as an investor, how many properties are you looking to purchase this year? What strategy are you going to focus on? Do you have partners? Which markets are you going to invest in? What's your big picture ultimately to grow your portfolio? Are you looking to quit your job?
Yeah, that's a big one.
Like in a couple of years from now? We want to plan for things like that, right? So the goal discussion is a big component to help us as mortgage advisors define and implement a strategy, financing strategy to enable you to get there. So that's the number 2 block. Number 3 is big block, which is aligning your capital sources. And I'm going to share with the audience here some tips on the key building blocks, starting with this one, aligning your capital sources. So what do we do here? Basically, we say, okay, you want to buy 3 properties next year and you want to acquire X number of properties over the next 5 years. Great. Where is the money going to come from? Let's think about it now.
Yeah, so, big question.
So that you're not going random about, this money topic, number 1. And number 2, you don't want to be in a position where you get stuck. You're short.
No, that's it too.
Yeah, you don't want to be short on money, and you don't want to go and get money at and pay for it a price that is much more expensive than what you need to pay for it. So this is what we call aligning capital sources. And what we always tell investors is apply to get money when you don't need the money.
That is gold. Everybody listening, that never
apply when you don't need the money. And I like tapping into capital through secured line of credits. I'm a big fan of what we call advanceable mortgage products. So if you have a property, let's say, that is worth X and you have a mortgage on it and there is equity in it that you can take out and you qualify to take it out, I don't suggest that you take it out by increasing the mortgage. Why? Because you're going to turn your cash flow upside down.
Yeah.
And you're going to have a big chunk of money sitting in a bank account, and you're going to be paying principal and interest on that money while you're looking for properties. And it's going to hurt you down the road because now the lenders are taking a big mortgage payment into their calculation. So I always say, let's maximize on equity takeouts through secured line of credit. Secured line of credits will help you put that in your back pocket. Doesn't cost you anything per month. It doesn't hurt your lending ratios, okay, as much as a mortgage payment.
Yeah.
And you only pay as you go, okay? So that's a big tip for aligning capital. Set up the capital when you don't need it, set it through secured line of credits, and you want these secured line of credits to be advanceable, meaning they would increase as you pay down the mortgage, because over the long run as an investor, you're always looking for, capital to invest or capital to cover renovations or capital, in case
or a roof or who knows what.
So set it up on the right product upfront to continue to get access to that money, over the years.
And you can recycle it. That's something you mentioned earlier. If it's all a line of credit, you can tap into it again once it's paid off.
Yes.
Instead of a mortgage, once it's paid off, it's over. You need to refinance, reappraise, and that's painful. Anybody who's been through that, it's a lot of work. So do it once, do it right.
Yes. Yes. Even if a product like this costs you a little bit more in interest rate on the mortgage component, from a strategy standpoint, it's a powerful, powerful product.
Yeah, and you'll thank Dalia for years to come. And your team, I mean,
Thank
wow.
yourself for taking the action and making the right decision too, you
Oh,
know?
I have it on a few properties, and those that I don't have that, I'm like, oh my goodness, this would make such a difference because you see your statement each month, and now, oh, I have this line of credit growing. What will I do with it? And the equity, and I mean, it's just amazing what it can do for investors.
Yeah, 100%. So these are the first three blocks, sorry. Assessing your current state, talking about your goals, and then aligning capital. Would you like me to go through the remaining blocks?
Yes, please.
Okay, so the fourth one, which is also a key one, is what we call maximizing your borrowing power. So we want to plan for this upfront. You don't want to be in a position where you go apply for a loan and you hear, sorry, your loan is declined, or they cut down your loan amount, or you pay for a higher interest rate that you didn't plan for. Okay, so
Yeah.
you and these things tend to happen if you have not worked with a mortgage broker that helped you plan things upfront. So as mortgage brokers, we know how the lenders think behind the scene. Okay,
That's it.
as a client, you can go talk to the bank, but you wouldn't know what's beneath that iceberg. You don't really know
Nope.
how they think. How are they running the numbers? How are they evaluating your file? So that's my role and my team's role. So what we do, once or twice a year, is sit down and say, okay, knowing where you're heading, how are we going to open up borrowing power to make sure that you continue to qualify at the best cost of capital possible? What do I mean by that? Financing is a numbers game. So let's say, here are a couple of tips. Someone has an interest-free loan from Home Depot or MBNA. And, investors, we like sometimes to take these loans to renovate, which is great.
Yeah.
And you're not paying anything per month on that loan. And let's say you use $30,000 or $40,000 on that card. Well, there will come a time where we're going to need to pay down this loan or swap it with a secure line of credit. Why? Because from a lender's standpoint, as much as you're paying zero interest and you're not making a monthly payment, they're taking a big payment into consideration. So it stops you from qualifying with these lenders. So if we're proactive about figuring out strategies to reduce it, to help you move forward, that's great. Another example is around sometimes car loans.
Oh, that's a big one.
Big one, right? Sometimes you may have a car loan and you've got very little left on it.
But it's still $500 a month or whatever.
Got it. Yes, a big monthly payment. Although the loan amount left is small, the monthly payment is still high. And you're going, you know what? My loan is almost done. Why
pay it now?
Why pay it now? But again, from a lender standpoint, they're looking at your monthly obligations. So we help you find ways to clear that off your balance sheet. So how can we pave the way to make the numbers look better for your future financing? That's another trick. The third one is around big revolving line of credits. Sometimes, or actually most of the time, investors use line of credits over time to buy properties with, which is the, recycling equity.
But it adds up.
It adds up, exactly. At some point, you end up with a big line of credit, and we have to then convert portions of that to a mortgage, again, to help the numbers. So things like that are the things we guide you through this phase of the financing roadmap. Another big one, given the tax season, is as a self-employed client, report the right amount of income on your tax returns to help you qualify. Again, the power is in being proactive and planning. If you have filed your taxes and you just went by what the accountant is saying,
it's too late till next year.
Exactly. And you come to us for financing, we have to work with what you've reported. But if we're proactive and say, Francois, you want to buy 2 or 3 properties this year, here is how you should pay yourself from the business and how much, and let's talk to your accountant to talk about tax implications. Now we are actually optimizing what you should show and how much you need for financing purposes. So that's a very, very fundamental building block of the financing roadmap.
Yeah, and I love it because to a lot of people, paying zero or showing zero income is very sexy, but the bank does not like it. So it's not good. So you have to plan. And yes, there is a cost, but you're buying assets. So you have to be prepared.
Yeah, and I mean, there are situations where we actually advise the client not to show more income because
Yeah,
we look at how much they're going to need to pay themselves to qualify with a bank, what they're going to save versus what they're going to pay in taxes, and we'll then say, you know what, you better
yeah,
off saving here, although your mortgage rate is going to be higher here. Overall, you're still ahead. So we're able
that's
to
it.
actually analyze that and guide you through it.
That's excellent. Wow.
Yeah. So that's the fourth building block. The fifth one is what we call structuring your deals. And this is where the art comes in when it comes to a crystallizing how you're going to move forward. So typically, you go to a mortgage broker and you ask, how much do I qualify for? They give you a number and they say, here's the number.
Half
Okay.
a million, 1 million.
And here's the, okay. What we're able to do through our methodology is map out, yes, we will still give you that loan amount, big loan amount, but we're able to say up to up to two or three properties, adding up to 1.5 million, you can get it with 20% down, 30-year M at this rate. Past that amount, you'll pay this much. So we're able to actually break it at a more granular level to help you apply it at the property level. So you would understand what's your next purchase, the following one, the third one. That's number one. Number two, as part of this discussion, we guide you through whether you should put something in your personal name or in a corporate name.
That's a big question. Yeah.
How does it impact you from a financing standpoint? And that's what I tell clients. I can tell you from a financing standpoint what a corporation would do to the deal and to your future deals. I cannot tell you from an accounting standpoint what,
No.
and this is why we have to have the conversation with your accountant. If your accountant is saying we absolutely have to put it in a corp, then we will take that and revise the route, the financing route, to tell you what that's going to look like. If your
That's it.
yeah, so that's a big piece again of determining how you're going to move forward. And there will come a point in your portfolio where a corporation is going to become part of the discussion, and that's where
Yeah,
we
it's essential. And what can you give us some insights onto a bit of a difference? Because I think commercial, you'll need usually a larger down payment. Interest rate tends to be a little bit more, but doesn't appear on your credit. Like, what are the ins and outs of that? Like, just very briefly.
very briefly. Okay, so here's the thing: there is no black or white rule around when you should incorporate from a financing standpoint. Let me put that out, because clients think, okay, maybe I should incorporate upfront, because if I put my properties inside the corporation, they're not going to show on my credit report.
Yeah,
Ah.
not true.
Not true, Francois. Here's what I've seen on the residential side. There are lenders that, so when you apply for a residential mortgage in a holding company, you personally still have to qualify
Personal
for,
guarantee.
and you
Yeah.
provide your personal guarantee. I've seen mortgages in a corporation on the residential side show on the credit report.
Oh
Although,
my.
yeah, they've showed on the credit report, although the property is held in a corporation. I've seen that. I've seen, in some cases, mortgages that showed then disappeared, and
Oh,
in other cases they didn't show. So if you're using the corporation as a strategy to maximize the number of properties because you think by putting it in a corp it's not going to show on a credit report, don't do that. That's not a strategy. Okay.
yeah. It's not the main reason to do
It's
this
not
at
the
all.
main reason, exactly. But if it's more for accounting, then yes, that's the right thinking. Now, on the commercial side, if you're applying for a fiveplex, sixplex, and up loan, we're actually also able to approve smaller properties like a duplex, triplex, and fourplex if needed using the commercial rules. We can do that. A lot of people don't know that.
No, I know it's so overlooked. I'm like, Go commercial.
So overlooked because clients think, okay, I have a duplex or a triplex, it's a residential property. Okay, I should go and get a residential mortgage.
Not always.
Not always. Definitely the first path is residential because it's cheap,
Yeah.
right? But if it doesn't work, we can go commercial. Now, when you're having a commercial conversation with a lender and there is a corporation involved, it is unlikely for the mortgage to show on the credit report. But in some cases, it does show as something called a registration. So again, should you decide whether or not to incorporate for financing purposes? No, come at it from an accounting purpose and then let us for financing guide you through that decision because there are always pros and cons.
Yes, and lenders vary a lot, their terms and conditions, and yeah, and there's advantages. Like I've done some commercial with you, and yeah, I've seen some great advantages from different lenders. It's amazing. So what's the next step to or building block to get to that pot of gold of owning 400 assets?
So, part of the structuring the deals, we also talk about how you're going to structure things, let's say, with a JV partner, if JV money
Yes.
is the right source of money for you as an investor. So that's part of that discussion. And then we go over phase 6, which is answering your questions. As an investor, everybody has questions. We make sure you're clear on everything. And then 7 is avoiding the pitfalls. And that's where we help you understand that, like, the common mistakes investors make as they move forward and how to avoid them. Some of the mistakes we've seen are investors assuming that the lender will lend on the purchase price, where the lenders lend on
The value.
appraised value.
And that's happening more and more with these crazy bidding wars and hot markets in Canada, USA, other countries where I'm investing as well. It's people are like, yeah, it's not going to appraise, so you got to be ready for a lot more cash in the deal. So.
Bingo, exactly. You're buying a property in a hot market, and some investors are going in above asking. Obviously, like we see it now in Ontario all the time. Buying a property for 700,000 doesn't mean it's going to appraise for 700,000.
Nope.
So if you really want to go firm on the deal, you got to make sure that you've assessed the value early on, and you're prepared for a worst case situation in case it happens, in case the value comes in below the purchase price. To your point, you're going to have to inject more in the deal. So in the avoiding the mistakes or the pitfall stage, which is stage number 7, we talk about things you should watch for as you move forward. This is one of them. This is
very good.
Yeah. And then number 8 is really putting it all into motion and launching it. So before you go and put offers in, if we need to restructure certain things to open up room for borrowing, if we need to set up capital, if we need to tweak your financing, let's get these foundational things done before you go and put in offers. Because once you put the foundation in, you can build that house a lot faster.
That's it.
The foundation is shaky. Yeah, you may think that you're taking action and you're building it, but along the way, if you don't have a strong foundation, things may like tilt this way, or you may discover something later on that will cost you more. So launching your roadmap entails us implementing the things that we've planned for to build that strong foundation that you can launch off. And we've seen investors move a lot faster once they have these things in place. They're like, okay, I am clear on what I need to do. I know exactly how it's going to fall in place. Boom, 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 boom.
Yes. What's the expression again? It's not an ounce. An ounce of prevention is worth more than a pound of, what is it again? Or fixing or... So I see that totally here because just like you said earlier, the gold statement, applying for mortgages and for money when you don't need it, you're not stressed. You're not in that emotional space where this house or this building is perfect, we need to get it, and then bang, you get bad news. Oh, you forgot about your nice BMW at $800 a month, and you only have 3 payments left, but this we're considering $100,000 off your payment, or your credit space. All those things are essential. So I love this. Is there a cost for this, Dalia, to do all that? No. Wow.
No, this is all complimentary for all Streetwise clients. We do it with every client that starts to work with us, and on an annual basis, for those who would like to grow, we can sit down and do a reassessment or an update for the financing roadmap.
Excellent. I need to call your team for my next next acquisition. Absolutely.
Yeah.
And so this spoke about how investors scale as well as laying that foundation. Just like if you're building a skyscraper, you got to go in much deeper than the 6 or 8 feet down for a house. So if you're building much bigger, you need a better foundation. Takes a bit of time. It's not exciting, but as you said, once it's done, then you can go much faster afterwards and be confident as well with your decision.
Yes, not exciting. You got it. It's not exciting, but if you want to run much faster, you got to invest the time upfront.
Yeah, no, I love it. Just like taxes as well.
And mitigate risk, right?
Yeah, because a lot of people are risk averse, and we're seeing things in the world right now, risks we didn't think about, bombings and illnesses and who knows what. So you don't want to have to deal with all of that, plus have some silly banking issue because you didn't do proper planning. So, and laws are changing constantly. We mentioned earlier the interest rate went up. I'm sure rules are constantly evolving as well. Lenders have new things. Oh, now we do this way. 6 months down the road, it's different. So
all the time, you see all of these grays. You know.
No, you hide them very well.
That's where it's coming from.
This one's TD, RBC, Scotia.
Yes. Got a big one here too.
BMO. I love it. So what's the best way for an investor to reach out to your team, Dalia, and get started on this roadmap to success?
Simply email us at info@streetwisemortgages.com, or you can visit our website, streetwisemortgages.com, and just reach us through the contact form. Either way works.
Excellent. And you'll be joining us in the creative real estate investing community, where
Yes.
I teach people on investing. Dalia is going to be talking about creative financing, OPM. We can dig into that because there's a lot of misconceptions. People think you can just pull money and just whatever, but yeah, there's lots of laws around that, like money laundering, and this new mortgage administrator using registered funds. So all kinds of new hot topics to discuss. Dalia will prepare, and I'm sure you'll be ready for all the questions.
Yes, we've got some great topics to cover under creative financing, and also how
Commercial.
Yeah, like, vendor takebacks, RSPs, other people's money, joint ventures, private.
Yeah.
How do you actually put this puzzle together the right way to grow? These are tools available to you as an investor. So you need to understand how to use them effectively and when to use them to grow. And that's what I'm going to go over. And of course, I'll answer all questions.
Well, it's been a pleasure as always. Thank you so much. And I can't wait to catch up shortly on all these exciting topics.
I'll see you soon. Thank you.
Thank you. Bye.